Hey guys, Lance Martin with the Martin Group, and welcome to our January 2026 real estate market forecast. I cannot believe we are here. Happy New Year to you all. We finally hit the end of the year for me because this January beginning of the year is basically a look back on what we've done in the last 12 months. So I'm kind of excited that we got here, we made it, we survived 2025, and I do genuinely mean survive in a lot of ways. So let's go through and take a look. Got a little fast on the clicker. We have set the 2026 real estate market forecast. I've been talking about this for last couple of months. The date is set, March 11th. It'll be here before you know it, 2 months and a week. And we also have the venue set. We are going to go back to Ido Benzivi's place at Highland Fairview. He's been very gracious, and that venue, even though it's a little bit smaller, actually it's a lot smaller than some of our other venues, given how we work our attendance these days and so many people are watching our forecasts on YouTube or on social media, not necessarily showing up in person. I'm not disappointed because the venue is awesome and it's beautiful. However, if you do want to go, get your ticket early because it only holds about 120 people or so. So at any rate, March 11th at Highland Fairview office, same place we were in September, and we're back on schedule for our March date. So let's jump in on Southern California. So median price. So this is why I'm excited. So I ran these numbers this morning. Today, by the way, is January 7th. So I went into CRMLS, I jumped onto InfoSparks, I did my thing. We've got our median price, so I updated all of these links. Every now and then these links break, and I get a phone call from somebody that says, hey, if I click on the link, it didn't work. So all the links are good, and they're nice and pretty. So there's 15 years of data for the median sales price, LA, Riverside, San Bernardino, and Orange County. If you click here, you have that. So why am I excited? Because it was a very boring year from a price appreciation standpoint. With the exception of LA County, we have one negative number, negative price appreciation if there is such a thing. So we had a little bit of price destruction. Every time I say that, I feel so dramatic. Anyway, 2.9% negative price for Los Angeles County. Orange was flat. Basically, we started at 1.35 million and ended at 1.35 million, zero. Orange County Riverside County up a 0.5 percentage point, and San Bernardino County is close to flat. I put the flat here because, 0.1. It's basically flat. Now this is the deal. For those of you that are looking at Orange County or LA County and say, oh my gosh, Orange County is down 2.9%. When I come to January, that number could be up 2%. It could be flat. We get to January, Orange County could be down 1% or whatever it happens to be. So anything within a 2-3 percentage points of zero, one way or the other, to me is flat. So this is, as crazy as it sounds, this is what I've been kind of hoping for several years now. These 20% appreciation years of 2020 and 2021 and partially 2022. We talked about it. If you go back and you watch the snapshots, it's unsustainable. We're going to have to pay the price. It's going to be painful. And we've been paying the price, and it has been painful for the last couple of years. So we basically have zero appreciation, which again, if you own a house, you're like, well, geez, Lance, that kind of sucks. I would have liked to have seen some of that 20% appreciation. I got it, but we can't have it forever. So nice, boring, flat prices. So we'll talk more about what we think is going to happen next year with prices. Having said that, I guess maybe we can, don't skip ahead. This is California Association of Realtors. I forgot that I put this in here. This is California Association of Realtors Outlook. This is 3 months old. By the way, the California Association of Realtors meet the end of January in a couple, 3 weeks from now. They're going to update this forecast. I will come at my February snapshot and we'll compare what this forecast is, which is done in September, I believe, to what they're going to update it in January and see what the changes are. But as far as pricing is concerned, this was their 2025 forecast. They projected a 1%, this is statewide, by the way, a 1% appreciation in price statewide based upon what I just showed you. Let's go back. Okay, they nailed it. All right, now again, what happens in LA County or Orange County or Riverside or San Bernardino isn't necessarily what happens in the state, but from that perspective, they're spot on. From a pricing perspective, they are forecasting next year a 3.6% increase in median price statewide. Sure, okay. My forecast is the same. I mean, maybe it's 1 point higher, lower, it doesn't matter. But sure, basically 3.5% appreciation statewide makes sense. We'll talk a little bit more about this chart later on. Supply and demand numbers. This is the new listings. Again, this chart is brand new. It's been clicked or updated. You can click in here. I just will point out, as you look at this EKG for the 4 counties, and you go all the way over here to the end, you can click into it. It'll be a little bit visually more friendly. And you can just see these basically record low numbers as far as new listings. So what did that mean? 10% fewer, 17% fewer, 15% fewer, 9% fewer. Now remember, these are December to December numbers. So we got to put this in context. I'm going to go back one slide. And you have to click into it to get this. But we had this spike of inventory. And over the summer, we were thinking, oh my God, we got a lot of listings coming, which we were excited about. I was excited about it. We haven't had enough inventory. Great. We finally got some inventory. And then those sellers got a reality check and says, my house isn't selling as fast as I thought it was, and my house is not selling for what I thought it was. So all of that enthusiasm we had, which I had as well, we have a bunch of people coming to the market to sell. Well, that didn't materialize to connecting buyers and sellers, so they came off the marketplace, and instead of starting to see inventory increase on a monthly basis, we started to see inventory decrease again. So that's a little bit painful, but it also makes perfect sense because we have sellers out there that says, if I'm not willing to sell at the price the market will support right now, I'm just going to come off the market. Not to mention, this is December to December. It's holiday season, Thanksgiving, Christmas, New Year's. You tend to see fewer listings on the market, but you got to keep in mind, nothing's more, we're comparing to last December. So the same thing was true last December. So bottom line is new listings to the market took a fairly big hit. Double digit lower numbers. These are all listings on the market in the 4 counties. Again, 9%, 17%, 14%, 10% fewer on all listings. So again, same story as what I just talked about with new listings, just less inventory on the market. So if you're thinking, wait a minute, Lance, you sound a little bit conflicted on this. 6 months ago, 8 months ago, yeah, we don't have enough inventory. Then all of a sudden we're building inventory. I'm like, hey, we're getting in a lot of inventory, but it wasn't selling. But I was saying, hey, we can't complain. We've been bitching and complaining. We don't have enough houses to sell. We now finally have more houses to sell. Well, that was a short-lived window. That only lasted probably 3-4 months, maybe 5 months at the most. And now we're kind of back into this territory where we just do not have as many houses to sell. But I think this is a more healthy decision because these people are coming off the market, if for no other reason. The buyers just haven't been there because of interest rates and a bunch of other things. I'm not going to click into this chart, but if you were to go back into these new listings on the marketplace and you start looking at some of these jump ups and when inventory starts to come back up, the troughs on every single one of these is December, meaning in January and February and March, in April and maybe May, we're going to start to see that inventory build. So if you are a buyer and you're like, hey, I think I want to jump into the marketplace, the holidays are over, you will definitely have more homes to choose from. That is for sure, because that's just what happens every single year. So again, pretty much double digit fewer listings on the market in total for the 4 counties that we track. I switched the order of how these slides come in. I don't know why, up until this month, I've never done the listings and then followed it by the month's supply. It seems to kind of make sense. I don't know why I haven't done that. So if you take all of those listings that we just looked at, how many months supply do we have? Well, 2.7, 1.8, 3.3, and 3.5 months supply, which again is less than what we had a year ago. So again, you'd have to go back and try to put yourself where we were last December. And even though months ago we were talking about more inventory, well, now we're not in that situation anymore. There is less inventory on the market as far as month supply is concerned this December than there was last December, and in part because the buyers just have checked out. There just is very few buyers out there, but it is what it is. The days on market numbers are up, which makes perfect sense. Up 16%, 17%, 10%, 20%. It's taking longer to sell houses, a little bit of a broken record. If you follow this on a monthly basis with me, 42 days, 51 days, even in San Bernardino, 57 days on market. That's not crazy, unless, of course, you want to compare it to the last 10 years. If you want to compare it just to the last 10 years, Those are big numbers. We haven't seen 2 months, 60 days, 57 days on market in a very, very long time. Again, over 10 years. Having said that, I've been doing this almost 40 years, hard to believe, but that doesn't scare me, but it does scare a lot of other people out there. So at any rate, days on market have increased, but it is what it is. Pending sales, this is just the brutal part. I guess here we go. Pending sales, they are what they are. 15 years of data, all the way here to the right side, the lowest number. These are the lowest number of pending sales on record, okay? Somebody might go out and find something that says, oh, wait a minute, there was a period 32 years ago where pending sales as extrapolated out for inflation and all the rest, or not inflation, but, just population and all the rest of that were lower. I don't know. As long as I've been doing this, they've never been lower. Absolutely ridiculously painful. So what does that mean as far as our percentages are concerned? 33%, 31%, 19%, 16% fewer transactions, buyers and sellers coming together at the end of the year. This has been a broken record every single month, with maybe 1 or 2 months, but it was still negative month over month, month over month. It was just a matter of, is it a 30% fewer sales, or is it like 3% fewer sales? So every single month this entire year, the pending sales have just been brutal. This is CAR's chart. So I have a big question mark up here because they had this is 3 months old. Okay, it's the same exact chart that I had up a minute ago. Previously, I was highlighting what the prices were going to do. This is the forecast for unit sales. Okay, so 3-4 months ago, they had unit sales, 0.1% fewer unit sales statewide. That I stood up when they presented that, and I'm like, no, there's no flipping way, because the 4 counties we track, I don't know what it is, a percentage of the sales in the entire state of California, but it's not a small percentage, Riverside, San Bernardino, LA, and Orange County. So when this finally sorts out, I expect, at least on a statewide number, that number to be negative, kind of like what this one was back in 23 and 22, 22% fewer sales, 25% fewer sales. If it's not at least 20% fewer, as opposed to 0.1, then I'm going to have some hard looking at these numbers, because something is amiss. Okay, so at any rate, we shall see. I should have that number hopefully in the February report. But bottom line is, the stuff that we track, it's all double-digit fewer sales. 20 to 40% fewer sales year over year. Just brutal. Now they are forecasting a 2% increase in sales next year. Okay. Sure. In the same way, a minute ago, I said they're forecasting a 3.6% higher sales price in the state of California. Okay. I don't know. I'm not that good. That seems right, based on what we've seen. And the same thing with plus 2%. Believe me, I'd rather have 2% more sales in 26 than 2% less sales. But bottom line is, either one of those numbers is still brutal, because the sales numbers are still pretty rough. I'm hearing there's some other people in this room maybe who might think otherwise. I hope your guys are correct if you're of the mind that we're going to see larger unit sales. This is a chart I've had up for a few months. It's just highs in the wrong places and lows in the wrong places. I'm going to update the forecast. This is Jordan Levine from CAR. I'm going to put update. The charts I just showed you are Jordan's charts and his team. So I'm hoping when I go to Monterey in a couple of weeks, Jordan's going to have his updated forecast, and I'll update that, and then I'll get that to you. Same thing with the NAR forecast. I think I told you last month I was going to post the NAR forecast. I didn't do that. My father passed away early December, so I've been a little distracted. And for those of you that reached out, thank you very much. But we'll go ahead and we'll get the NAR forecast posted to our link in a little bit. I just pulled up Moreno Valley. Moreno Valley is an interesting one, because Moreno Valley, I've had an office there for 30 years. It's kind of a bellwether, almost a canary in a coal mine kind of a city. It almost has that reputation because it got hit so heavily during the foreclosure crisis back in, well, all of the foreclosure crises, the ones back in the mid-90s, and then again from 2006, 7, 8, 9, 10. But so what happened in Moreno Valley? Negative appreciation in the city, 2.7%. Not crazy, but again, 2.7% negative year over year. So it is what it is. 550 is that price, by the way. Active listings. Only 181 listings in the entire city of Moreno Valley as of December. That's a 36.5% fewer than there were in the previous year, which is horrible. If you go in this super high spike, you got to be careful with this, 3,400 active listings. Again, this is the foreclosure crisis, the Great Recession, whatever you want to call it back in them. Having said that, I've been tracking this data for long before this, and it was not unusual for the first 15 years or so I did business in Moreno Valley for there to be about 1,500 houses for sale in the city at any given time. So we got a little more than 10% of that right now. And that's been the trend for quite a while. But at any rate, not a whole heck of a lot of houses for sale in the city. And then the sales, we sold a total of 60 houses in the city of Moreno Valley at closed escrow. Buyers and sellers came together. This is not closings. These are open escrows, pending sales. 13% fewer than a year ago, which is still a miserable number. When even during these windows, we're selling, I don't know, let's just call it, somewhere between 150 and 200 houses a month. Well, that's a pretty rough month. And by the way, look at all these huge numbers over here. So there wasn't all bad stuff going on during that foreclosure crisis. There was a lot of sales going on. And if you happen to have bought a house during this window, you're very, very happy. So at any rate, there's your snapshot city for the month of January. Interest rates have become kind of boring. Having said that, I'm going to spend a little bit more time on them today. We're at 6.2 on Mortgage News dailies. The 10-year bond is 4.145. By the way, this is 6 hours ago. January 7th is when I did this snapshot. You can click in here and see it yourself. Okay, a couple of things. For those of you that did not go to the real estate market forecast that we did on September 10th, 3 months ago, there was a little bit of news, if you will. At least I think it's news, because it's also a little bit contrarian to what some other folks are saying out there. So this slide up here I've had on my forecast for 6 or 7 or 8 months. And this is Wells Fargo. They came out with their forecast and basically said, we're going to have a 6.5% interest rate for the next 2 years. Because this came out in early 2025, or certainly April, May of 2025. And I had that on there because that felt right to me. I don't know. Again, a lot of it's gut for me. I try to look at the data, but that seemed to feel right. So I'm like, okay, great. And then Chris came along. This is his quote. If you hit 6.5%, grab it. So this is about a 10 or 15 second little video clip of Chris speaking. And this is on September 10th when Chris is making this statement. So let's listen to Chris.
And I've been saying for a long time, it's not going anywhere. It's not going down. It's not going up. I think mortgage rates, if you hit 6.5%, grab it. Because it's going to be fluctuating between 6.5% and 7.5%.
Okay, so if you believe Chris, then guess what? You should, if you're a buyer, you can get an interest rate right now below 6.5%. So grab it, okay? So I obviously put a lot of stock in Chris. I've been following him for years, and he's not always spot on at the right time, at the right place, but as far as his long-term record is concerned, he's better than anybody else I've ever followed. So at any rate, so he's got his 6.5% number, which aligns very, very nicely with the Wells Fargo forecast. This is that, matter of fact, Adam, our videographer, said, you're not going to play that old one. So no, I'm not going to play this video. This is a very fuzzy image of me 50 pounds ago. But at any rate, I bring this up because this was Chris in 2001 saying we're going to hit 7% mortgage rates, and we did. So this is Chris 90 days ago talking about our current interest rate environment. This is a little bit of a longer clip. It's about 1 minute, 20 seconds.
So Lance ended his presentation with what he thought interest rates are going to be. What is your prediction on that?
It's a great question. So again, my point, I said to Lance back then, and look, financial markets are volatile and they move on narratives, right? So there's two things here. But this goes back to actually, when I first started doing this, I was on stage and there was another forecaster there, and he was an older guy, and he walked up to me afterwards. He said, kid, you're good. You're really good. But I got a word of advice for you, because when it comes to forecasting, give them a number or give them a date, but never give them both. That's what I've done. Even back then, I gave you a number, but I didn't give you a date. But it happened. So now, look, it went up, it stabilized, and I've been saying for a long time, it's not going anywhere. It's not going down, it's not going up. I think mortgage rates, if you hit 6.5%, grab it. Because it's going to be fluctuating between 6.5% and 7.5% until the next big break. The next big break in narrative is when the dollar starts to drop and the money starts to come and the bond auctions are going out and no one's buying. And that's when the 10-year bond goes up and you get another surge in the mortgage rates. What are we going to? I would put us 9%, 9.5%, easy. What do you mean no? I mean, guys, it was 14%, 15% in 1983. The end is not nigh. The market will adjust, but while you're adjusting, there's obviously some big hits to be had. Now, when does it shoot up again? I'm not giving you that date because I don't know.
Okay, so there you have it. By the way, I hope Chris is wrong, and the next time we're at 9 or 9.5%, which, by the way, I just love the way he threw in the word easy at the end. Oh yeah, 9%, 9.5%, easy. And there was people in the audience groaning. One of those was probably me. I hope Chris is wrong. I guess at some point, if he uses, give him a number or give him a date, at some point he'll be right. I mean, I don't know, 2 years from now, 20 years from now. But when Chris made that forecast from 3% to 7%, I was like, you are out of your freaking mind, dude. There is no way interest rates are going to double plus in a matter of a couple years, and he was right. So this is the deal. Take that for what it's worth. Now, before I move on to the next slides, Fannie Mae, no small, heavyweight or no small, contender, so to speak, in the mortgage world, is predicting sub 6% interest rates, forecasting sub 6%. So sometime this coming year, which would be awesome. I would love to see, I'm very selfish, I would increase sales and I need to sell houses. So we'll see if that happens. It very well may happen. I will tell you, I can't speak for Chris. He'll speak for himself in 2 weeks or 2 months from now, and I might have him in studio here to do a more in-depth interview. He'll say, yeah, sure. Okay, yeah, sure. They knocked on a below 6%, but at some point in time when this next event happens, fasten your seatbelt. So we'll see. Mortgage Bankers Association's got a little different trend. This is the chart that I've been talking about. We are frozen, but I will tell you, one of the reasons I spend so much time talking about interest rates, because if you are a seller or you're a buyer, I want you to do I want you not to do what I've been doing for the last 2 years, which is obsessing over mortgage rates. It does have a huge impact on my business and my ability to conduct a brokerage business. But if you're a buyer or a seller that have been kind of praying and hoping, well, you heard what Chris said. If you can get a 6.5% rate, grab it. So if you're in the marketplace and you can afford it and it's a house you want, you can get better than that. So if you trust Chris, grab it. And if Fannie's correct, maybe you'll get lucky and you'll pick up a rate below 6, and we'll see what happens. But anyway, this chart materially hasn't changed. So what's my forecast? I'm predicting flat everything. I don't think we're going to see prices do a whole heck of a lot. I don't think we're going to see inventory, which, by the way, inventory always goes up. But as a trend for the year is concerned, I don't think we're going to see anything crazy with inventory one way or the other. I'd love to see sales volume increase. I just don't see it. If CAR says, what did they say, 2%, 3% increase in sales volume, that would be awesome. That would be my prayer every single evening. Please let me sell more houses. I just don't see it. I don't see it given what we currently have. And then mortgage rates flat, which flat for me right now means materially within a half a point of where we are. So which, by the way, would mean we potentially would be at 5 and 5.8 or something like that, up to 6.5 or whatever. So I think Chris said 6.5 to 7.5. I'll say between 6 and 7. I want to say between 5.5 and 6.5. I would love to be able to say that. Hopefully at some point in the month or in the year of 2026, I'll be able to say we have an interest rate that starts with the number 5. But I'm basically forecasting flat, flat, flat. It just feels like that's where we're going to be. Still looking at vacant listings, price reductions, and buyers. Nothing's changed. We look at that all day, every day. So I mentioned earlier, we have our forecast scheduled for March 11th. You can be able to buy tickets here in the next couple of days. Follow the links, and yes, buy a ticket and get it early. I don't have that much room if you want to go, and it'll be at Highland Fairview. We're also going to do our real estate and politics. We don't have the date set, but it will be in June. I also have 2 new things I'm going to do. I don't talk hardly ever in this real estate market snapshot about our property management department, but I have 2 new monthly videos I'm going to be shooting. One of them is on landlord tenant updates. So if you are an investor landlord, I'm going to be completely honest with you. This is not really geared so much towards tenants. If you do rent a house, by all means, watch it. But this is really geared more towards property owners and investors as to what are the rules, the ins and outs, and all the rest of that. Obviously, it ties into Cobalt Property Management, which is our property management company. And then in addition to that, you may not know, we also do a pretty significant amount of homeowners association management within the Cobalt Property Management family. And I've done an absolute horrible job of letting people know that. So that's going to change as of January 2026. So if you are interested in either one of those, you'll be able to find a link that links this video to these other videos on our property management stuff. So you can look for a landlord-tenant update every month starting January 2026 and a homeowners association update on how basically, what's the rules and regulations and statutory requirements for a homeowners association and how we help you guys manage through those. And lastly, we've got the same QR code we've always had. You can find my stuff there. So Happy New Year. Hope you have a fantastic 2026, and we'll see you soon.